Okay, today we're going to start section 3 finally. Today's class was supposed to be by not Richard, but I don't know why he's not here yet. So I guess I'll just host it. And we are a bit late as well. So yeah, let's begin. So section 2 and section 1 was basics. Okay. Second, let's just look over here. Section 3 is, you can say, the longest. Oh, never mind, there's section 4. But like section 3 is an important part. It's all sole traders and stuff. Like it's everything related to sole traders, such as these financial statements. And then this is gonna be topic for like all businesses. And then there's this is also like for all businesses. So like this part is important. Okay, section 3 is important. And it's easy as well. Don't worry about it. Everything's easy. Okay, I think we should just start right away. Mm, somewhere here. Okay. Well, alright, that should do it. So financial statements part A, we're gonna cover both part A and part B today, I think. Because like this they're divided into two parts. The disadvantages and advantages of operating as a sole trader, the importance of preparing income statements. We already discussed what income statements are. They're the financial, okay, they're one of the financial statements, and this is a final account. We use it to calculate the profit or the loss made during the year. The difference between a trading business and a service business is exactly what it sounds like. A trading business is people who do trading, giving and taking of goods, buying and selling of goods, that sense. And service business is people who give service, so like your insurance company and that kind of stuff. Okay. Prepare income statements for both. Make adjustments for goods taken by the owner for own use. We already like discussed this topic, this I don't know what do you call it, like this concept before, and it's the concept of drawings. When the owner makes drawings and you do stuff to the capital and all. Balance ledger accounts as required to make transfers to financial statements. Okay. Now, before we already did balancing ledger accounts, and we knew that it's pretty simple, right? You just like if one side is not equal, then you just do CD on the lower side, and then you make it total, you make it equal, let's just say 200, and then you do BD on the opposite side. But when you wanted to transfer to financial statements, most of the time it's going to be your income statement. Instead of writing CD, you're going to write income statement. All right. We'll have a look at that. Okay. You will learn about partnerships and limited companies. Okay, anyway, all the previous chapters have been, oh, all the previous chapters were like related to sole trader, and for the previous chapters, it's similar for the businesses as well, such as partnerships and limited companies and manufacturing accounts. Okay, anyway, I think I'll like read and explain. Okay, because I don't even know what this chapter has, but yeah. I'll just read and I'll explain. When a person is operating a business alone as a sole trader, business alone means a sole trader. Okay, so like sole trader is being the only owner of the business. He or she is entitled to all the profit the business makes. This is the advantages of the sole trader. Okay, that you get all profits, but will be responsible for any losses. So like, okay, that's a disadvantage you can say, but you know, just covers it up. Business decisions will be made quickly. Consultation is not necessary. No one whom to share this decision making or the workload. So like this is the advantages and disadvantages. When they ask you a theory question, like 5 markers in the CIE, then you need to give this kind of answer. So like you have to give two advantages, two disadvantages, and then 1 mark is like for your recommendation, like a yes or no. The capital of the business will be restricted to what the trader is able to invest because there's only one person. So if I have $20 million, then I can only invest $20 million, right? But if I'm a partnership, then whatever money both partners have, we will invest. And if it's a company, then we'll just sell shares and we can, increase the capital anytime we want. Okay. So in sole trader is limited to whatever the trader is able to invest. Okay. Whereas other firms can have access to capital invested by other owners, like if it's partnership, then other owners can do it, and if it's a limited company, then shareholders can also invest. When a person starts a business, the aim is to make profit. The profit is calculated in financial statements, which are prepared at the end of each financial year. Basically, consists of two parts. There's one income statement, and there's statement of financial position. We've already discussed both of these. but we're just going deeper into it. So income statement has two sections: a trading section, which in which like we calculate up to the gross profit, and then we have a profit and loss section where we calculate the profit. So you take gross profit and you subtract your expenses. Okay. So your trading section basically just your income statement until like that's related to your trading. Okay. So you're buying and selling of goods. So you in your trading, they probably will explain the format. I think I'll just go with it. Okay, an income statement is a statement prepared for a trading period to show the gross profit and profit for the year. Okay, so the main part is the profit for the year, but for that we just calculate the gross profit. Okay, the first part is the trading section. When they ask you to make only the trading section of an income statement, then you just calculate to the gross profit and you stop there. When they ask you to make an income statement, they don't mention anything about trading section, then you do the whole thing, like both of these. And when they ask for profit and loss section, then you do from gross profit to profit for the year. Okay, and the trading section and the profit and loss section are part of the double entry system. This means that the entire income statement is part of the double entry system. What does that mean? It means that it has debits and credits. Okay. Now, statement of financial position is the assets and liabilities, and then we calculate the capital. This is not part of the double entry system because it's like your total balances, and then you just put them in one place to give a summary. Okay. Financial statements are prepared from a trial balance. We already discussed this as well. Each item appears once in a set of financial statements. A set of financial statements means like it can appear in income statement and balance sheet both, but it's only gonna come once, all right? Actually it might not even come in both of them. That's probably very rare. As each item is used, it is useful to place a tick against them to show that no items are overlooked. This is just them telling you to be careful and not make silly mistakes. Anyway, you find accounting notes accompanying a trial balance about various adjustments which are to be made. Okay, now this adjustments, it's not a really easy concept. You just have to understand it once. Okay, and it's of course once you understand, it's all very easy. It's good, bro.
भाई स्कूल से हूँ मैं.
Yo, was good, was good. Okay, I was wondering. I was like, do I know him? Or is he the one?
हाँ,
Oh,
स्कूल
how's
से
it
स्कूल
going,
से हूँ
bro?
मैं.
Nice, nice, nice. All right, thanks for joining. Anyway, any notes, one second, about adjustments are to be made. Now, this will be explained in the following chapters. We saw the chapter for other payables and other receivables. It's in that, okay? But don't worry, it's going to be easy. Any notes to a trial balance are used twice in a set of financial statements to ensure that this is done useful. Place a tick against the notes each time you use. Okay, a tick of the items of a trial balance and the notes. I don't know what notes they're talking about. To a trial balance, as you use them so that nothing is omitted every time a trial balance is used within a set of financial statements. Any notes are used twice. Okay. The term revenue. Okay, now we're having a look at a trial balance, and we've already discussed this. You can just change like summarize the trial balance into the small mnemonic. Right now it's limited, like this does not have drawings and this does not have capital, and it's not perfect. Okay, but I will explain the accounting equation later, and that will like cover everything. Okay, but this mnemonic for now is just to get a concept. So this is our credit side and this is our debit side. Revenue is credited, sales is credited, so sales return will be coming on the debit side. Purchases, debit side. Purchase returns, of course, is the opposite, credit side. Carriage inwards, it's an expense, expense is debit. Inventory is an asset, assets are debited. And discount received is an income, is going to be credited. Discount allowed is an expense, debit, which is expense, 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 expense. Asset, 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 it's a liability, liabilities will be credited. Asset, asset, liability again is a long term, but it's a liability. And then capital on the credit side is like C for capital, C for credit. And drawings on debit side, D for drawings, D for debit. All right, now look, one more thing. They did not take, where is it? They wrote inventory, but they didn't write the date. Okay, they wrote the date. You see, they did not take closing inventory. They did trial balance at 31st May, but they took inventory opening. Okay, we already discussed this in like the chapter trial balance, that when you're making a trial balance, you only take the opening inventory. Okay. All right. During the year 31st May 2008, took goods costing for his 300 for his own use. No entries have been made in the accounting records. Okay. This means that the trial balance does not have anything for this 300, and we have to do it ourselves. All right. Trading section of the income statement, buying and selling, and its purpose is to calculate the gross profit. What's the gross profit? The difference between the selling price and the cost of the goods sold. Okay. So it's to calculate the profit earned on the goods sold. So like, in a business you have your normal expenses such as your rent and all that kind of stuff, like these expenses. Yeah, this is limited to that. Without these expenses, you make sales. Whatever profit you earn on them is your gross profit, okay? Because you also have other expenses. You have selling price, you have cost of sales, because you need to buy the good itself. You need to pay delivery on the good, if any. So there's a whole formula for cost of goods sold, and it's like just shorten it. You can just write opening inventory plus purchases minus closing inventory. But as you progress, they're going to give you the entire formula, which is a bit longer, but it's just, you just understand the concept instead of memorizing the formula. Mm, yeah, I don't know where they explain it, but yeah, I'll teach it, don't worry. The formula to calculate gross profit is selling price minus cost of sales. So selling price of goods, just better to write it as sales. Okay, sales minus cost of sales is your gross profit. So the total revenue you made minus the total cost of making that revenue is your gross profit. All right, the selling price represents the total sales less any sales returns. So you can write net sales. Okay, the selling price here, they mentioned selling price of goods, and they're saying that it represents total sales minus sales return. So I just wrote net sales because that sounds cooler. All right, the cost of sales represents the total cost of goods actually sold. The total cost of the goods actually sold. Okay, now this term actually sold is the reason why we're doing this opening inventory, closing inventory stuff. I'll explain it. This is not necessarily the cost of goods purchased during the year. Some goods may have been stocked at the start of the year, and some goods purchased during the year may remain unsold at the end of the year. Okay, does this part make sense, or do I explain it? I mean, when I read it, it was pretty much clear. So do I explain it? So like, let's say I have a business, all right, and I bought $100 goods, and in my first year I made $0 sales, and in my next year I bought $10 goods and I made $90 sales. I sold this and I sold $80 of this. Okay, so when I make my cost of goods sold, I'm gonna write opening inventory, which is gonna be 100, plus purchases, which is 10, because like I bought this year, minus closing inventory. What's my closing inventory? It is 110 minus 90. That's like what, 20? And this gives me the total amount of goods I sold. Okay, which is 80, right? 110 minus 20. Oh no, it's 90. What's going on? So you see, you get the total amount of goods you sold, right? Yeah, pretty much simple. And that's why we do opening inventory minus closing inventory. But like, this explanation is good enough. I was probably confusing you guys here, I guess. Anyway, all right. So that's the formula for cost of goods sold. Now, if we extend this formula, or if we just expand this thing, you add purchases and you can subtract purchase returns as well. Because if you have purchase returns, then that reduces the total cost of your sales, because you're not selling these goods. Okay. And if you have any drawings of goods, then you also remove that. So minus good drawings as well, because that reduces your cost of sales because you're not selling this stuff. All right. Opening inventory plus purchase minus purchase returns minus drawings plus carriage inwards and minus closing inventory. All right. So plus carriage inwards because it's an expense of bringing the goods into your business, and that calculates to your cost of sales, because to sell the goods you needed to bring them to the business, and it's a cost. Okay, very much common sense. The purchase represents total purchase minus any purchase returns. If carriage inwards has been paid, this must be added to the purchases as it increases the cost of the goods. If the owner has withdrawn goods for personal use, this is credited to the purchase account. Why is it credited to the purchase account? What does this mean? We normally, like we saw in a trial balance, that purchase normally has a debit balance. So crediting the purchase account means you're reducing the total purchases, okay? And that's why we credit the purchase account here. So reducing the cost of goods available for sale. Okay, because credited to the purchase account. If goods taken by the owner have not been recorded, they must be deducted from the purchases. How? Just the way I said, net purchases. So instead of writing purchases here, you will write purchase minus purchase return plus carriage inwards minus goods for own use. So like, this is goods drawings when you take them out of the business for your own use. And remember, this will only be in the form of goods because we're talking about cost of sales here. Okay, you don't really sell your money, so it cannot be in the form of money. Okay. All right, where was I? Yeah. The calculation of gross profit is shown in the trading section of an income statement. This must have a heading which includes the period of time. It is also easy to include the name. Okay, okay. All right, what's calculated in a trading account up to gross profit? What's calculated in a profit and loss account? The profit or the loss. All right. But how do we calculate it? Is it going to be sales minus cost of goods sold or cost of sales? And this is going to be gross profit minus all expenses. Okay. You also add other incomes if you have any incomes like discount received as an income. So you add that and then you subtract all your expenses. Formula for calculating gross profit, sales minus cost of sales. Formula for calculating cost of sales, just write the small formula, no need to go into much detail. Opening inventory plus purchase minus closing inventory. But if it's your CIE, then go into as much detail as possible. Opening inventory plus purchase minus purchase return plus carriage inwards minus drawings, and then what, minus closing inventory. All right, and they said previously that this whole thing is purchases. Okay, over here when they say purchases, they mean this. What's going on, bro? 1 second. Do you have any tips on how to memorize the format of an income statement? Don't memorize it, understand it. I'll explain. We'll come to the format now. All right, using the trial balance and accompanying notes. So when they say accompanying notes, they mean this kind of stuff, this and this. All right, the reason they gave us closing inventory over here, they didn't put it in the trial balance, but they gave it to us, is because we need to make the income statement. And we need cost of goods sold for that. Okay. All right. Also, what if you're saying something, you can say in, like if you're saying something to the related to the session, then you can just type it in the chat. This chat. Anyway, trading section of the income statement. Wait, what? The format of the income statement. Okay, so this is the format of the income statement and it's the trading section, meaning it's all the way to gross profit. Now you notice that this is the T account format of an income statement. All right, and you can see that sales are being credited, sales returns are being subtracted here. So it's not your normal T account. It's not that you debit to subtract, but it's something similar. Normally, when you make an income statement, you make it in this format, the vertical format. Okay, so you can see it's this one's like very much simpler. But to understand double entry, you need to know this. Okay, so you basically understand that credit side is anything increasing the profit, and debit side is anything decreasing the profit. All right, because we have our cost of goods sold here. But once you look at the this section, you will understand it better because all expenses coming on the debit side, and then your profit is coming as a balancing figure, and then anything that increases the profit, meaning your all your incomes are coming on the credit side. So you can just write it as something like this and remember it. So whenever you want to make a double entry and you have journal entries and you want to credit or debit income statement, then you will check. Debiting the income statement means putting the stuff on this side. Okay, this is the debit side. If you debit the income statement, it's to transfer an expense. If you credit the income statement, it's to transfer an income. We'll come to that later. Right now, we just have to know the debit and credit side and like their point. Okay. What do they say about this? As these items are entered in the trading section of an income statement, they should be ticked off the trial balance and accompanying notes just to, make you feel good. The gross profit is carried down to the profit and loss section. So you see, this is gross profit CD, but they don't really have a BD over here. They have a BD over here and this. And then they just subtract all expenses and they get your profit for the year as a balancing figure. All right, then they're adding the income here. Okay, the first money column on each side has been used for adding and subtracting items like this. You see, this is their total purchases, right? So like they're doing purchase minus purchase return over here, then subtracting goes foreign use over here, then adding carriage inwards, and then they're putting this final amount over here. Okay, so the second column is for like final amounts. Okay, if you have any calculation, you do it in the first column. There's two columns for this thing. A trading section can also be prepared using the vertical format, which is used during exams and all, used by most businesses. A statement prepared using this method contains the same information but looks like an arithmetic calculation because like it's all plus minus. This is sales minus cost of sales minus sales returns minus goods and then you get your gross profit. Then you do minus expenses. You add discount received, you less all your expenses, and then you get your profit. Okay, so this one's way easier. Okay, using the trial balance and a continuous prepare the trading section for the year, use the vertical format. Now you can see it's literally the same thing. Over here they have revenue and you're subtracting sale return, you're doing revenue less sales returns, then you subtract cost of sales. How do you do it? Opening inventory plus purchase minus purchase return minus goods add carriage minus closing inventory, and then you get your final value for purchases. You subtract that, sorry, you get your final value for cost of sales, this being your final value. Where's final value for purchases? 64 65,000, 64,500, 64,200, 65,700. Yeah, sorry, this is your final purchases. This is your opening inventory, and then you add this, you get this, and then you subtract this, and you get this. Okay, so this is our total cost of sales. You subtract this, and you get your gross profit. Make sense or not? I think I'll label it. This is opening inventory, this is purchases, and now they're doing opening inventory plus purchases, which is 72,800, and then subtract closing inventory. We write it in brackets to show that we're subtracting it, and then you get 65,200. This is our final amount. We subtract it with our revenue. This is our cost of goods sold, and you can see that we get to our gross profit. Okay, the first two money columns has been used for adding and subtracting items, and the final column for the section final section total is like the total of your cost of goods sold, the total of your sales, and then the total of your gross profit. The first column has been used to adjust for purchase returns, carriage goods, and goods of our own use, and the final cost has been entered in the second column. So you see they use three columns. In one column they just put all the YAP, in the second column they put semi-final amounts, like the opening inventory final, the carriage inward, sorry, the closing inventory final, and the purchase final. And then in the third column, in the last column, they put everything, the final values. Okay, in reality, like in the exam, if you put everything in one column, the examiner won't do anything, but like you don't lose marks for that. But if the examiner doesn't like your handwriting, or if the examiner's mood is not good, he's just gonna deduct marks for no reason. Okay, they will have a reason, and the reason will be like when you see the script, you won't find a reason. You see the stream and hear my voice because I changed rooms so the internet isn't as good. But can you please give feedback on that? Is everything in the stream and all clear? Yo, can you can you guys hear me? Can you guys see the stream? Oh my god. Okay, but what about the stream? Like, can you see what I'm doing? Well, I guess I'll just keep teaching. If there's any problem, someone will probably say something. Okay, so that's how you do calculation till your gross profit. So you just take your sales minus cost of sales to calculate cost of sales. You take your net sales, so like you say, it's minus sales returns. Then you take your cost of sales, you calculate it using the formula, and then you subtract it from your total net sales, and then you get your gross profit. Okay. Now, profit and loss section of the income statement is considered profits and losses, gains and expenses. So, like, you take your incomes and your expenses and you calculate the profit for the year or loss. Its purpose is to calculate the final profit after running all expenses and all other items of income. Other items of income can be like your discount received or rent received. So, if you're having a, separate, just like you have a business for something else, but you're just renting out part of your own office. So you can say that as rent received. The formula for calculating the profit is profit plus other income minus gross profit plus other income minus expenses. Other income is just what I said, and expenses can be your normal expenses, rent, wages, insurance, utilities. Okay. Profit for the year is the final profit after any other income has been added to gross profit and running the expense and the running expenses have been deducted. Running expenses as in like running the business, expenses that are needed to run the business. Okay, so your yearly expenses. All right. As with the trading section of an income statement, a profit and loss section can be prepared using either horizontal or vertical. Using the horizontal format, the gross profit and any other income are shown on the credit side and the expenses are shown on the debit side. Okay, the difference is equal to the profit. If it's on the credit side, it's a loss. If it's sorry, profit for the year, if the credit side is the largest, yeah. So like if the greater side is your credit side, then whatever the difference is your profit. So like right now, our credit side is greater by 13,900, and that's why we put the profit on the debit side. If your debit side is greater, means your expenses are more than your income, then of course you're making a loss, and that will come over here on this side, making a loss. All right, using the trial balance and accompanying notes, prepared profit and loss section of an income statement. So you can see that anything increasing the profit coming on the credit side, anything decreasing the profit coming on the debit side. This is all our expenses, and this is our profit for the year. The gross profit came from the trading section. Okay, a profit and loss can also be prepared using a profit and loss section of an income statement can also be prepared using the vertical format used by most businesses. A statement prepared using this method contains the same information, but again looks like an arithmetic calculation because it's all add and subtract stuff. So you take your gross profit, add any income like discount received, rent received, interest received, whatever. Like if it says received specifically, only then it's an income. If it says only rent, then that's an expense. Okay, if it says rent received, that's an income, sure. Then you subtract your expenses like discount allowed. It's an expense because you allow the discount to your customers. They pay you lesser, so it's an expense. Wages, general expenses, property tax. Now they wrote profit from operations, and then they wrote it separately, and then they wrote less loan interest, and then profit for the year. You don't need to do this, but it'll just impress the examiner if you do it. Okay, so your interest comes after profit from operations. All right, and your profit for the year is the last thing. Profit for the year is like the final. Okay, nothing's after that, at least in IGCSE. It's easy to show the profit earned from the normal trading and the final profit for the year after reduction of any finance costs. Okay, so they call this a finance cost because it's a loan interest, interest on loan. So it's not related to your business. It's not your running cost. It's a finance cost. So you do profit from operations separately. You take any finance cost, mostly your loan interests and that kind of stuff, and then you get profit for the year. But it's not necessary. You're just gonna look cool if you do it. Okay. Six business expenses, including those shown in the excluding those shown in the walkthrough. So you can just write anything: depreciation, uh, bad debts, rent, wages, utilities, electricity, water bills, whatever you feel like. Okay. The formula for calculating profit for the year, so you just write gross profit minus expenses plus other income. Sorry, you add your other incomes and minus expenses. All right. The two sections are usually presented in the form of one combined statement, which is your income statement for the year. Like this is the whole thing. This does not have a trading section or a, or what do you call it, profit and loss section separately. It's just together. Okay. Heading income statement includes the period of time covered by the statement and the name under which the business trades. So this is, wow, this can't be the name of the business, bro. Anyway, so 31st May for the year ended 31st May 2008 means that anything related to this year is in this income statement, okay? All our incomes, all our expenses. If anything is related to the next year or previous year, then we have to adjust for that, okay? And that's what adjustments meant. Like in the previous, in the beginning of the chapter, we read that word, All right, at most businesses prepare their income statement using the vertical format. This method will be followed in the remainder of this book and also during your exams. Using the trail balance or trial balance, whatever, okay, prepare the income statement, and here it is. Sales minus cost of sales, net sales minus cost of sales, you get your gross profit, add any other incomes, minus or total expenses, you get your profit for, you just get your profit for the year directly if you subtract every single expense, even your finance expenses. Now, the fun part and the hard part, transferring ledger account totals to the income statement. So, you know how normally you were just to balance everything, instead of writing balance CD, I literally just mentioned this like at the start of the class, instead of writing balance CD, you're just gonna write income statement and you're gonna close the account over there. Okay, let's have a look. Anything appear in the income statement must have a double entry in another account, because we discussed in the beginning that income statement is part of the double entry. Anything credited to the income statement must be debited in the appropriate ledger. What does that mean? This is the credit side. One second. Where is it? Sure, I think I'll use this. This is the credit side of our income statement, and this is the debit side of our income statement. Anything credited to the income statement, let's just say discount receipt, or this example is probably better. Yeah, never mind, it's not better at all. Let's just say sales. Anything credited to the income, so the income statement will be debited to the appropriate account. Okay. Now, if we go to our sales account, sales account. Wow. Okay, they only ask us to make purchase account. Let's just take purchases then. So you see purchases come on the debit side of the income statement right here. This is the debit side. So in your purchase account, income statement will come on the credit side. Okay. As you can see, this is the credit side, and this is our income statement. Now, normally we know that purchases are debit positive, meaning like if you want to increase your purchases, you just write stuff on the debit side. And that's why, since you want to transfer this value, this is the total of the whole year, and you want to transfer it to the income statement. So you credit the purchase account. This reduces the value of the purchase account, and now the purchase account is zero, right? Because everything went to the income statement. So you're basically reducing the value of the purchases, and that's why you put income statement on the credit side of the purchase account. And the double entry would be to debit the income statement, as we can see over here. This is the debit side of the income statement, and purchases have been debited to the income statement. All right. Mm, and then vice versa, anything debited to the income statement must be credited in the appropriate ledger. When something is deducted from a debit item in the income statement, this is equal to a credit entry. So a debit entry is required in the ledger. Oh, what are they yapping about, bro? I wonder. So far, it's just simple transfers. The entries shown as totals to date represent the total individual entries made in the account for the year 31st ended to or 31st for the year ended 31st May 2008. So you can see that this is total to date, date as in this date, So like the total for this year, okay? The total wages for this year 11,200, like that. And then you transfer the entire thing, the whole year, to the income statement. All other items in the income statement have similar transfers from the appropriate ledger accounts, excluding this. Okay, they're a bit different, they're weird. The gross profit technically has a double entry within the income statement as it is transferred from the trading account to the profit and loss account section. So the gross profit doesn't really have a separate gross profit account where you write income statement on some side. The gross profit is just gross profit CD and gross profit BD, but you don't even have to write that in your exam. You just have to write gross profit, add income less expenses, profit for the year. Okay. And inventory, we'll discuss it probably. They're going to show it to us right here. Okay. Yeah, the gross profit technically, okay, I sure done. Okay, the entries for inventory and profit for the year I explain next. Okay, you all understand this, right? Like if the account is if it's a credit positive account, let's just say this is a credit positive account because it's an income, like like when you have pearls, let's just take it. You have your income, like revenue is an income, and it's on the credit side, like credit positive. So this is also credit positive. Total to date is 400 and you want to reduce the amount, so you debit the account with income statement because you want to transfer it to the income statement. So this is basically transferring the entire discount received for the whole year to the income statement. And it being income statement coming on the debit side of the discount received account means that discount received will come on the credit side of the income statement. As you can see, credit side of the income statement, you have discount received, same value. All right. Okay. Now for inventory account, it's something I never paid attention to, and I probably never understood it till like I don't know the end, and I just memorized the format as well. But yeah, it's pretty simple. There are two entries for inventory in the income statement. Why two entries? Because we have opening inventory and we have closing inventory. Okay, the inventory at the start of the year and inventory at the end of the year. The inventory account will have a debit balance representing the entry at the start of the year. Why is it a debit balance? Because inventory is an asset, right? And we know that assets have a positive debit balance, meaning like if you want to increase the asset, you debit the asset account. Okay, so to represent that there is positive inventory, you write 7,100 on the debit side. There possibly cannot be negative inventory. Okay, and then one second, debit balance representing the inventory value at the start of the year. This is credited to the inventory account and then transferred to the debit of the income statement. This 7,100 is your opening inventory, right? 1st June. It's transferred to the income statement for what? As your opening inventory. Again, same thing. So like in your income statement you have both opening inventory and closing inventory. So first you have you have your inventory balance BD on the debit side. On the credit side you transfer it to the income statement. Okay, and then you get this as income statement. You transfer it again to the income statement for closing inventory. You can see 31st. And this is also transferred on 31st because you prepare the income statement on 31st. You prepare the income statement on the last day. You don't prepare the income statement for the whole year at the first day because you need the expenses and everything for the whole year. You can't just assume that you will have this much expenses, right? You need to have a record. So that's why the income statement is prepared at the last. And this is also transferred at the last. And then this is also closing inventory. You just, when you calculate your inventory, you go like, nice, nice. And then you just transfer it. The entry of 7,600 debit side representing the inventory at the end of the financial year becomes the opening inventory for the next year. Okay, so you're just gonna have some balance BD, balance CD stuff, like CD here and then BD here. But I think that's not even necessary. Like in the exam, you just need to do it till this stage. You just need to know this much. All right, a profit for the let's not go there right now. Everybody understands inventory account. So firstly, you just had your balance BD. You transfer it to the income statement. This is your opening inventory. You transfer it to the income statement. You close the account, tuck, 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 and now you put your closing inventory. Okay, on the closing date, you just write income statement because you're transferring it to the income statement. Anyways, all right. Now profit to record the profit because they said that Only a few stuff is different. Inventories transfers are different, gross profit transfers are different, and profit for the year have different transfers. Everything else has similar transfers, as in like just debit or credit, and completely transfer the entire thing. So now moving on to profit for the year. Oh, this works. Anyways, a profit returns a profit represents the return on the owner's investment. What does this mean? The owner invests, let's just say $100 million, okay, and he makes a profit of $10 million. So this is a return on the amount he invested. Like this is what he got as a reward for investing this 100 million. Okay, so it's a return on the investment. It's a profit. It will appear as a debit entry in the income statement. Why debit entry in the income statement? Because like we just said that it's going to be balancing figures and all that stuff. So you see, like your if your expenses are greater, then it's going to come on the credit side, but that will be a loss. Since your incomes are greater, the profit will come on the debit side. But there's probably a more logical reason for it. We might find out. This will appear as a debit entry in the income statement and should be transferred to the credit of the capital account as it increases the amount the business owes to the owner. Or you can say that it increases your total capital, right? The amount a business owes to the owner is your capital, is the definition of capital as well. So when you make profit, you increase your capital, right? You had $100 million in your business. You made $10 million, and now you have $110 million. This is your total capital now, right? So it's increasing your capital. What do we know that capital? We know about capital is that it's a credit positive account. So crediting the account will increase the total capital, and that's why we're crediting the capital account. It will appear as a debit entry in the income statement and should be transferred to the credit of the capital account, and it will increase the amount the business owes the owner, or it will increase the capital. A loss will just be the opposite, a credit entry in the income statement and the debit side of the capital account, as it reduces the amount the business owes the owner. The business owes the owner, again capital, it reduces the capital. The total of the drawings account is transferred to the capital account at the end of the year. Which side? Debit side. Why? Because it reduces the capital. Okay, let's have a look at an example. This is our balance BD at 2007 June 1. This means that this is our total capital into the business right now. Like this is how much we have in the business. This is how much we have invested. Then we make drawings of 9,300. It reduces our capital. This is our balance CD. One second, we have a profit before that. We have drawings of 9,300 and we have a profit of 13,900, and then we do balance CD, balance BD. So the first year, this is the first year. No, it's not the first year. At like 2007, we had 90,000 capital, or in 2008, we have 94,600 capital. What caused the increase? The profit for the year caused the increase. Okay. And the drawings, like say my drawings were 93,000, so that would of course cause a decrease, and my capital would be, oh, never mind, it cannot be 93,000. It cannot be greater than the amount you actually. Oh, wait, it can. Because, like, if you're, well, that's a crazy concept. Never mind. But if your were greater than your profit, then you would have a reduced capital. Like, you'd have a lesser amount of capital, right? Your capital would reduce to like maybe 80,000 or something, which is not a very nice thing. All right, all right. Inventory account is clear, I hope, and capital account is also clear, I hope. You just have to debit anything that decreases the capital and credit anything that increases the capital, because capital is credit positive. You know, if a business make a profit, it is credited to the capital account. So this is the capital account and this is the credit side. Credited to the capital account as it increases the capital. If it's a loss, it's debited to the capital account because it decreases the capital. And then drawings, if the drawings is coming on the debit side of the capital account, then capital will come on the credit side of drawings account, right? Very simple. Because like the double entry or the journal entry for drawings is to debit drawings and credit capital. Wait, what? Yeah, no. What did I do? Oh, this is your end transfer. My bad. You don't really credit capital at this stage. Normally, you just do debit drawings and credit purchases, let's say. In this case, they have it, right? Drawings is debited with cash purchases, and this is our total drawings for the year. But when you're transferring it to the capital account, you're reducing the balance of drawings. So drawings is positive debit, but you want to transfer it to the capital account. You want to reduce all the drawings you have. You want to make it zero, so you put it on the credit side and you write it as capital because you're transferring it to the capital account. All right. And then in the capital account, you're just going to have the opposite thing. Okay, so it was debit drawings, credit purchases to record the drawings, and now you will credit drawings and debit capital. We write the debit first, debit capital because it is decreasing, and credit drawings because it is also decreasing. Okay. Why is it necessary to make two transfers from the income statement to inventory account at the end of the financial year? One is for opening inventory and one is for closing inventory. As you can see over here, this transfer is for the opening inventory and this transfer is for the closing inventory. Okay, because this is 1st June 7,100 and this is also 7,100 and 7,600 representing the inventory at the end, which is the closing inventory, and it will of course become the opening inventory for the next year. Why a loss for the year is debited to the owner's capital? Because it reduces the capital or it reduces the amount the business owes to the owner. Okay, exactly as I said, it is debited to the capital account as it reduces the owner's capital. All right, this is a long chapter. I think we'll just, okay, never mind, we can probably cover it all today. I hope. Anyway, a service business is one which provides a service. A trading business is one which sells and buys and sells goods. I already mentioned this. It does not sell goods. The service business does not sell goods, such as an accountant, like he's just gonna do the accounting stuff. An insurance company, travel agent, hairdresser, your bank, whatever, just they're giving service. Okay, they're not selling you goods. At the end of the financial year, these businesses also need to prepare financial statements because they have a profit and loss as well. They have feelings too, but they don't have a trading account. Okay, so their income statement is way easier. You don't need cost of sales and you don't need all that gross profit stuff. Okay. However, the trading account is not prepared as no goods are bought and sold. Only the profit and loss section of the income statement and the statement of and a statement of financial position are prepared, which is your balance sheet. Okay. So a balance sheet will be pretty much the same thing. In the income statement, all items of revenue receivable, such as fees from clients, commission, and are credited and expenses are debited. The same thing as before, like you have your income statement. Debit side is going to be your expenses or anything that reduces the profit, and credit side will be your incomes or anything that increases the profit, such as fees from clients or any revenue receivable thingy, like your revenue, your income. Okay. The statement of financial position is the same as a trading business. Now let's look at the example. They have commission received and they have rent received. This is the total income. Then they have all of these expenses: property tax, general expense, insurance, printing, loan interest, wages, and then the balancing figure is their profit for the year. Okay, let's look at the vertical format. You take your total income and you subtract your total expenses. Then you just subtract your uh, finance costs separately if you want to. Okay, but you see that this is very easy. You just take your income, you subtract your expenses, you get your profit. You probably get like 5 marks for this or something because like there's no work in it. But for this, you probably get 5 marks. In the exam, they won't even ask questions as simple as this. They will ask you, they will ask you with adjustments. So like that's a different thing. Let's not mix it right now. Anyway, revision checklist. The difference between selling price and cost price is known as the gross profit. This is calculated in the trading account section of an income statement. So this is just the formula for calculating the gross profit. Gross profit is equals to sales minus cost of goods sold. All right, the difference between gross profit plus other income less expenses is known as the profit for the year. This is calculated in the profit and loss account section of the income statement. So again, this is just saying you how to calculate profit for the year. So you just write profit for the year is gross profit plus other income minus expenses. All items appearing in the income statement are usually, where is it? Are transfer. Yeah, all items appearing in the income statement are transferred from ledger accounts to complete the double entry. Meaning, like in your ledger accounts, you transfer them and you complete the double entry. Complete the double entry because if you only write it in the income statement, then that's just one part of the double entry, right? Who's going to complete the other? You have to do it yourself and you have to transfer, your end transfers to the income statement. Okay. A profit for the year is transferred to the credit of the capital account and a loss is transferred to the debit. Credit of the capital if it's a profit because it's increasing the capital. Debit of the capital account if it's a loss because it's decreasing the capital. A business which provides a service only prepares the profit and loss account section of the income statement because they do not have any trading activity. That's why they don't need to prepare a trading account section. I feel like, okay, well, there's suddenly, wait, what? Why did the messages just go and vanish? What on earth? Whatever. If you guys typed anything, I wasn't able to see it because I don't know. Give me a minute, I'll actually get my phone. Maybe it's in my pocket. Ah, 1 minute. What did you do today? Today I yapped for 50 minutes straight. That's an achievement. Okay, 1 minute. All right. 1 minute, 1 minute. Highest down. I'm gonna to drink took way too long. No screen share. What? No way. Can you guys still not see my screen? This is what I was. Okay, wow. Wow. Couldn't anybody have like, oh no, start them, open their mic and tell, whatever. Uh, yeah, I mean, I'm recording. The recording is going perfect, but like you guys were literally staring at the air for how many minutes again? It's been 15 minutes. Wow, man, I don't have that much patience. Yeah, thanks for waiting. You could have just opened your mic and told me. But it's working now, right? It's working perfectly, or it's just working? All right. Okay. Now for chapter 9, financial statements part B. This is going to be the statement of financial position, which is very simple. It's literally this: assets equal to, what was it, liabilities plus capital. The accounting equation is the whole, is this. Okay. Understand the statement of financial position, record assets and liabilities, recognize and define the content. Okay. Understand the interrelationship of items, prepared statement of financial position for trading business and service business. All right, my leg is itching really bad, bro. Anyway, introduction. Introduction. My name. All right. A statement of financial position is a statement of the assets and liabilities of a business on a certain date. Now, there are a few new fancy words. There's like non-current assets. Non-current assets means assets which are not current. I'm a genius. Are assets which are obtained for use and not for resale. For example, like your truck. You're a transport business and you buy a truck. So you don't really sell that truck to anybody you see. For example, a customer comes and he goes like, yo, nice truck. So you don't be like, hey, I got it for 10 million, but I'm going to sell it to you for 25 million. Want to buy it? You don't do that. You just keep it and you just use it. Okay? It's not meant for resale and it's meant to help the business earn the revenue. Yeah, but the thing is, like, that's the thing. Like, you can say that, okay, I bought this furniture yesterday. I bought it for like $10,000. But now some guy comes and he goes like, wow, nice furniture. That's probably worth 20,000. And then you go like, oh, you want to buy it for 15? Okay, bet. And then you just sell it, but you make 5,000 profit. You can do that, but you don't do that really. Because like, you're not supposed to buy furniture every single day, you know? Feel me? It's not meant for resale, so you won't sell it. Okay? You'll just keep it. You'll just let it be. Okay, leave it alone, like that sense. All right. Financial statements consist of income statement and financial statement of that thingy, the balance sheet shows the assets of a business, what the business owns, and what is owing to the business. This means like what other people owe to the business. An example is trade receivables, all right, and the business owns is like cash, very simple. And the liability is what the business owes on a certain date, like the money you owe to your bank. because you're broke, that kind of stuff. Experiencing a problem with the stream. You're probably not the only one, but like nobody's telling probably. I'm gonna change my room and you should be able to see everything better now. One second. You should see everything perfectly in a while. Magic. And it's working perfectly now, right? I know it is. Thank you. Keep saying stream failed. Thanks for letting me know though. These people would probably have waited another 15 minutes. Can't say anything. I'm just impressed. Okay. Yeah, on a certain date, the assets show how the resources are being used and the liabilities show where they come from. Wow, that's kind of new. That's kind of weird as well. Like, what do you mean the liabilities show where they come from? My cash is where they came from. What are you gonna do about that? Anyway, so liabilities where they came from, as in like if you buy a loan, if you take a loan from someone, then that's your source of finance for buying your Bugatti or whatever. Okay. Define a statement of financial position, shows the assets and liabilities of a business at a certain date. Yeah, the pen is behaving. It's very rare, right? Anyway, I don't know how much patience you guys have, but I don't have that much patience. Anyway, I explain the meaning of each of the following items, terms. Asset, something you own or other people owe you. So like, your trade receivables owe you money and that's an asset. And you own your cash and that's an asset. Liability is what businesses owe to other stuff, other people. You learned how to prepare elementary statements of financial position in chapter 1. If the totals of a trial balance are equal, the totals of the statement of financial position should balance. Okay. If they do not, there is an error somewhere in the financial statements. What it may be here on the next lesson. It's tomorrow. Today's lesson was supposed to be by not Rishad, but then I don't know. Like I was sleeping, I woke up and then I was like, 5:30. Oh wait, it was 5 o'clock, and I was like, 5 o'clock, and then I just like got up and then I just quickly I don't know, got ready or something. And then I started. It is usual to arrange the assets and liabilities into different groups according to their type. Assets are divided into two types. These are non-current assets and what? And current assets. Non-current assets are two types: tangible non-current assets and intangible non-current assets. Right? So, oh wow. Tangible non-current assets are your long-term assets, but tangible is like you can touch them, and which are obtained for use rather than for resale. They help the business earn revenue. Okay, okay, including your land, building, machinery, fixtures, motors, like your car, whatever. Okay, your truck. So that's a tangible non-current asset. Okay. In your balance sheet, it's usual for the non-current asset to be arranged in increasing order of liquidity. This means that the most permanent assets are shown first. Liquidity is like, how close something is to being cash. All right? All right, okay, right. So, for example, cash is the most liquid. Bank is the second most because you just have to. Oh, wait, actually, bank is also considered liquid. Trade receivables are the second most because you just have to get the money from your, what do you call it? From your customers, okay? But land and buildings, you don't really sell that on a daily basis, so it's not liquid at all. And then machinery, you can sell that, sure. Motor vehicles, people sell that much more than they sell your fixtures and equipment and that kind of stuff. So like when you make a statement of financial position, if you keep it in this order, you're gonna look cooler, okay? You won't lose any marks for not keeping it in this order, but this is just a nice way to do it. A typical order for showing tangible non-current assets in a statement of financial position is as follows. You take your land and buildings, because like this is the least liquid, and then yeah, I hope so. I won't be able to join. I won't be able to join because of French tutoring. Will you check your handwriting? For the handwriting, like if I show you my script, I think I showed you, right? They don't really do anything. Your handwriting just has to be readable. My handwriting was readable, I hope. So like it wasn't that big of a problem, all right? But like I got to know that one of my friend for Islamia, like he wrote a lot of stuff, but his handwriting wasn't nice, and they deducted marks for that, which is very not nice. Anyway, intangible non-current assets are again long-term assets. This is, non-current assets means long-term assets which do not have material substance. You can't touch them, feel them. They don't have feelings. Never mind. They have feelings, whatever. They belong to the business because they're an asset. Everything it's an asset is something that the business owns and do have a value. Examples are goodwill. brand names, trademarks. Okay. Now, in our syllabus, you only need to know the names of this stuff, and they rarely ask it in the exams, but you just need to know it. You don't need to know how it's an intangible non-current asset and all of that stuff. But goodwill, brand names, and trademarks are an intangible asset. Okay. They're shown before the normal tangible assets, but you barely have any intangible assets given by the question. Okay, but still be prepared for it. You will learn more about goodwill very much in the future. This is the last chapter, and I don't know when we're gonna have it, but yeah. Now, current assets are short-term assets. They their values are constantly changing. Constantly changing means that their value changes during the year. Okay, because they arise from normal trading activities of the business, and their their amounts are constantly changing. This is the reason to why their amounts are changing. These are in the form of cash, or which can be turned into cash very like comparatively easily. Like you can't really sell your land and building that easily, but you can sell your goods that easily. Okay, so your examples include your inventory, trade receivables, bank cash. This is something that you're gonna have in every single balance sheet. Okay, like you have this is the most basic of the current assets. Like, but if it's a if it's a service sector business, then of course you won't have your inventory and you won't have trade receivables. Okay. Anyway, in a similar financial position, it is usual for current assets to be arranged in increasing order of liquidity. That the asset furthest away from cash are shown first. So again, you just have to apply the same concept. Furthest away from cash first, and then cash is the last. So inventory, trade receivables, bank, cash. Okay. Let's look at the definitions. Goodwill is the amount by which the value of a business as a whole exceeds the value of separate assets and liabilities. This is basically when like your capital. Oh, I'm not sure much about this, but it's like my sir didn't teach us much. He was just like goodwill, yeah, more or less. But it's like when you have a negative capital. Okay, you can say that it's a rare thing in IGCSE at least. Current assets are short-term assets whose amounts are constantly changing. Constantly changing means like their amount changes within the year. And non-current liabilities, where's non-current assets? Wow, it's about non-current assets not for resale and help the business earn. Non-current liabilities, amounts owed which are not due for repayment within the next 12 months. I already discussed this in like chapter 1 or 2 or something. And current assets, short-term assets, amounts are constantly changing. Current liabilities, amounts owed which are due for repayment within the next 12 months, meaning that you have to pay them back within 12 months. Liabilities are three types: capital, non-current liability, current liability. Capital is a liability because it's the amount owed by the business to the owner. Okay. And the non-current liability is, as we just said, current liabilities again, as we just said, their amounts are constantly changing and their amounts owed by the business which are due for repayment within the next 12 months. Thanks. Should I say thanks? Anyways, examples of current liabilities include trade payables and bank overdraft because their value keeps changing, right? Every time you sell goods on credit, your trade payables will increase, and every time your trade payables pay you, your trade payables will decrease. Okay, so that's why their current liabilities, their values are constantly changing, and they're also like due for repayment within the next 12 months. Oh, sorry, trade payables is like you have to pay them, not your customers. Every time you pay trade payables. I think that's what I said, but like I forgot. Anyway, define the 10 non-current assets. Illustrate your answer by giving two examples. So you can say that non-current assets is your stuff you bought for for the business, but not for making, not for making profit, not for selling, which are obtained for the use and not for resale, which help the business earn revenue. So you can say that it's your motor vehicle, your truck, or your furniture, or your machinery, or anything that is not meant for resale, even your screwdriver, literally. Okay, state the order in which current assets are arranged in the statement of financial position. They are arranged in increasing order of liquidity, meaning that the most liquid will come at the last and the least liquid current asset will come at the first, which is inventory. Yeah, inventory. Stay okay. Explain how to distinguish between a non-current liability and current liability. Non-current liability is to be repaid after 12 months, and current liability is to be repaid within 12 months. The repayment is due like within the next 12 months. Poof. Okay, poof. This is just yeah. There are two ways, again, horizontal, vertical. Horizontal is prepared in two-sided format. It is usual for the assets to be listed on the left, which is the debit side, and the liabilities to be listed on the right, which is the credit side. You cannot say debit and credit. You know why they're saying left and right? They're not saying debit and credit. It's because this is not part of the double entry. Okay, the balance sheet is not part of the double entry. The statement of financial position is not part of double entry, and that's why, of course, there's no double debit and credit. We can. The reason I said debit is because we remember it this way, that assets are debited and liabilities are credited, so it would be easier to understand. Okay, but do not mix it or something. All right. Anyway, the profit was 13,900 from the income statement. Trial balance was used in chapter 8. Well, that goes back in, I don't know, whatever, to prepare income statement for the year ended 31st May 2008. So this is all the stuff we used in the income statement already. Is all. And now we have to prepare a balance sheet with the rest of the stuff. This is our assets and liabilities, and we have our capital as well. This is, remember, opening capital. All right. Inventory valued was 7,600. This is a closing inventory, and this is our goods for its own use, and no entries have been made in the accounting records for these two. And yeah, that's pretty much. As explained earlier, every time within a trial balance is used once in the preparation of a set of financial statements, any notes are used twice. The items already used in the preparation have been ticked. This is the items used in the preparation of the income statement, and the purpose of them was to get ourselves our profit for the year, which we got, and it's right here. Where is it? This thing. Okay, now looking at the format, or looking at the answer for the statement of financial position. Debit side, we have our assets, non-current assets, current assets. Credit side, we have our liabilities. And we mentioned earlier that there's three types of liabilities: capital, non-current liabilities, and current liabilities. Why is capital a liability? Because the business owes this money to the owner. Okay. So non-current assets, you can see premises, which is your basically buildings and that stuff, fixtures and equipment. You don't really intend to resell this stuff. And then you have your inventory, you want to sell this. You have your trade receivables, this is the amount other people owe you, that's why it's an asset, and since its value will change constantly, it's a current asset. And then bank and cash, they're current assets as well. Then capital, they gave us 90,000 only, like directly they gave us capital 90,000. This is our opening capital. All right. And then we have to add our profit for the year because that increases the capital, then subtract our drawings because that decreases the capital. 300 was our drawings which was not recorded, and 9,000 was our drawings which were recorded. So we just do a total 9,300, and then we take our liabilities, our non-current liabilities alone. How do we know if it's non-current? Where is it? Long-term loan. Okay, you see, long-term loan means that it is more than 12 months, and that's why it's a non-current liability. And then we have current liabilities, trade payables, the amount we owe to our suppliers. Mm, okay, we already discussed all of this. There are several acceptable forms, because you can just the vertical format as well. Vertical. Okay. So it is important to classify the assets and liabilities into the different types. So for writing this, there are marks. Say you forgot to write this, you're gonna lose marks. But if you write this, you won't really gain extra marks. Crazy, right? Okay, now the same thing, but in a vertical format. When the statement of financial position is completed, every item in the trial balance should have a tick against it, and each note to the trial balance should have two ticks against it. Okay, looking at the same thing, you have our assets. What kind? Non-current and current assets. The total of the assets is 112,400. Then we have our liabilities, capital and liabilities. Capital, we take anything that increases the capital and add it. Subtract anything that decreases the capital. We get our capital. Then we take our non-current liabilities and current liabilities. Then we get the total 100,000, 112,400, 112,400. You see what happened here? This is what happened here. Assets equal to capital plus liabilities. Very simple. And if assets are not equal to capital plus liabilities, does not mean that the equation is wrong. It means that your answer is wrong. Okay, so make sure you correct it. The first section of this statement shows how the resources are being used, and the second shows where the resources have come from. Okay, now this is a better statement. Before they said that liabilities show where resources come from. That's not necessarily true. Here's what happened. You have premises 80,000 and you have fixtures and equipment 13,900. Where did you get them? Maybe you invested the money in form of capital, or maybe you took a liability, and that's how you bought, that's how you got the money for this. So your capital and liabilities, this is what's financing your business. This is where all your money is coming from, and this is where the money is being put to use. Okay, so assets, whatever you own, is equal to your capital plus liabilities. This is the financing part thingy, and this is the stuff that where you're using the finance. Okay, so you can see that you have $100 in cash, and you have $3,300 in bank, and you have a lot of inventory. But the main part is your assets, non-current assets. Okay, they're very your premises mostly. Anyway, most businesses prepare their statement of financial position using the vertical format. The method will be followed in the remainder of this book, and even in the exam, it's the same thing. And yeah, shows the assets and liabilities. Non-current assets are long-term assets. The most permanent are shown first, meaning like you don't really sell them. They're the least, like they're the last thing you want to sell. Okay, you don't really sell your business land. All right, you can sell your machinery, you can sell your motor vehicle, you can sell your everything, but you don't really just sell your business land. The thing is, I am I'm a student right now, and like no, in short, I'll eventually like study AS accounting myself, and then I'll start teaching that as well because accounting is nice. Current assets are short-term assets and their values are constantly changing they're changing within the year. In a statement of financial position, the furthest away from cash are shown first, which is inventory in most cases, like at least right now. Non-current liabilities are amounts which are not due for repayment within the next 12 months, meaning like you have to repay them after 12 months. They they have to be repaid after 1 year. They last more than 1 year. And current liabilities is they have to be repaid within the next 12 months. And that's it for today. Next class we're gonna have like super boring stuff. I hope not Richard takes this because I don't want to teach this. It's like very, very boring because like it's theory. Can you imagine that? But yeah, it's important, you guys have to, everybody has to understand this. Well, it's easy, but it's just theory, so it's boring. Yeah, exactly. I feel you. Like, even if you like it, you have to act like you hate it, because if you don't, then people might hate on you. Okay. So yeah, then there is this nice concept. Oh my God, I dropped my status the second time. There's this nice concept of inventory valuation, which might make you like, I don't know, like pull your hair, out of your head, that kind of stuff, right? But it's easy. Everything in this chapter is easy. If you get this kind of stuff in your exams, just I don't know, start praying. These tables are very annoying and like they're very tricky, and most of the time a single word will will like change everything, and then your answer will be wrong definitely most of the time. But you see, this whole chapter is full of theory, and that's why I'm hating on it. Yeah, but like only this inventory valuation part is the nice part. And then the next chapter, this is the fun part, okay? What do you mean with depreciation? I mean, no, look, you can get this kind of stuff, these tables, you can get them on errors, you can get them on inventory valuation, you can get them on multiple places. Depreciation is a whole different chapter. I don't get what you're trying to say. Then this chapter, uh, I like it because it's hard, and then like, many people find it hard, but it's actually really easy. So I wish I can teach this, but I guess tomorrow's class will be by not Richard. So yeah, see you guys there.